I always forget to click on the on stage button. Good afternoon, everybody. This is Dante Royster with Epic Lunch and Learn. I think it's episode 58. Hope everyone is well. I'm just checking in on our guest to see if he's going to join me today. Hopefully, he still has availability and time. So let me just let me just send a message to him. I thought today would be a good day talking about credit. Um, for those that know, basically we set up YouTube basically as a platform to really disseminate information, get information out to you, so you have availability. You can get it on your phone or on your iPad or laptop if you're still rocking with the laptop. How many people still working with the laptop? I know I'm a little outdated, but hopefully we are. And we have Jay.
Dante, how are you?
I'm good, sir. How are you?
Doing great, doing great. Nice to see you again.
Nice to see you as well. Appreciate you joining me today. I wanted to, talk about credit because obviously, from a mortgage aspect, we deal with, let's say I take you, for example, and I say, hey, from day one, we want to get a good job. And once we get a good job, we want to, start disseminating where this money goes when we have a job, right? We want to say some of it is going to be for your lifestyle, going out with friends and family, and then a portion of it's going to be for your retirement sake. But throughout your journey, buying a house is something that it intrigues everybody. Everybody wants to maybe get into the real estate market, maybe not necessarily as an investor all the time, but it seems like it's a smart thing to do. And so, going through that path, credit becomes a major concern, especially in the States, because we have to obviously, review everyone's credit and analyze. And, I just had a conversation just a minute ago, just talking about, some people are willing to do, you know, ungodly things to, get a piece of property, to get in the game. And that's where fraud protection and prevention is there. And that's where CRS is there. So I wanted to kind of, start off the whole segment with, just explain, what you do and what your company does.
Thank you, Dante. First of all, I really appreciate you inviting me to your talk. Really excited to be here. I'll start with introducing myself. So, my name is Jay Shah. I head growth at CRS Group. CRS Group is a CRA, so we are a credit reporting agency. And our founding team, especially our CEO, comes with a lot of background and experience in the credit data space, working at some of the top mortgage credit data resellers. And we are fortunate to have a credit reporting agency license. There's only 80 of those currently in the United States, which gives us a lot of independence to operate on behalf of credit bureaus. We're also an aggregation platform, so we are authorized licensed resellers to the three big credit bureaus and many other data providers like LexisNexis, CoreLogic, PitchPoint, Finicity, CIC. So, what we have tried solving as a company is really consolidating our the data needs that one might have on a single platform. And we work with many lenders today. We have more than 1,500 customers, and they all use us to consolidate their vendor relationships under one umbrella. And we do that very well on the tech front as well. We're an API first company, so we make it extremely easy for our clients to pull that data and make more use of the data points.
It's a situation where I got some stats here. It says mortgage fraud increased 23% year over year, according to CoreLogic. And so, and that's what I'm kind of talking about. Mortgage fraud is still a thing, and so lenders as well as loan officers as well, we need to protect ourselves. We need to make sure that we're, judging what we're supposed to be judging the right way. And so, working with, a vendor like yourself allows us to have a little bit more familiarity with each and every client that, comes to us. And so it says one in every 90 mortgage applications contains elements of identity manipulation. So can you talk about some of like the LexisNexis and what type of manipulations could that potentially be?
Yeah, absolutely. That's a great topic, and I think it's getting more and more relevant with the increase in fraudsters and them having access to technologies like AI and the dark web. Today, I would classify these frauds into three broad categories. The first one is first party fraud, where it is an individual that is misrepresenting their own information to to probably get a mortgage. Then you have third party fraud, where someone is stealing another person's identity and posing themselves as someone that they are not to get access to, you know, money or credit lines. And then you have synthetic fraud, where you almost these fraudsters spend a lot of time cultivating these identities that might exist as a real person in the credit bureau's data sets, but such a person actually does not exist or is deceased a long time ago. We are seeing an increase in all three kinds of frauds. First party has always been around, but I don't think there's enough technology around to flag third party and synthetic frauds. With a lot of solutions that we have in the market today coming from organizations like LexisNexis, AtData. There are many small fintechs solving the same problem as well. The three bureaus have their own proprietary identity verification and authentication products, like TransUnion has True Validate, Equifax has InstaTouch, Experian has Precise ID. Each of these products solve two broad things. The first thing that they solve for is confirming whether this person who is making the application is actually the person he says he is. And the way they do that is by, of course, cross referencing the PII that has been provided, and then take it a notch further by sending you a device verification link or an OTP, or asking you those knowledge based questions to further authenticate your identity. So,
Yeah.
yeah, please.
No, no, to second that, synthetic identity fraud is the fastest growing financial crime. And on average, it can cost lenders, $6 billion annually. I mean, it's very expensive and it's very scary that, you're basically, I was thinking of like a business, right? A business has an EIN number, and in a sense, like, you have these fraudsters that are actually creating people with socials and date of births, like you said, whether they're, passed away, they're dead, and trying to get through the system so they can, create this, real estate arbitrage almost. So it is something that needs to be. I'm curious, how do you source your credit data? How do you source it?
We source our credit data directly from the bureaus. So we have a direct API connection, and we plug into the three bureaus directly. So when our customers get set up with us, first of all, it's a very simple and convenient process. Because we are a credit reporting agency, they get set up as a customer of CRS, and that relationship gives them access to credit reports from the three bureaus. Now, there's many sellers or agents in the market that are acting as agents and middlemen between the credit bureaus and the clients that might be pulling these reports. But that entails establishing an independent relationship with each one of the three bureaus. With CRS, you don't have to do that. You purely become our customers, and that gives you access to all the data points. So today, our team, most of it based in San Francisco, have done the amazing job of going through the tedious documentation from each of the credit bureaus. Sometimes their API docs are more than 600 pages long. And we really simplify that integration into a very quick and easy to implement set of API documentation. We see some clients go live in as less as one afternoon.
Mm. It's it's important because obviously, just taking it from the mortgage aspect, we have a client, they fill out an application. Right now, we're using FICO, and we'll get into FICO Advantage in a second. But we're looking at their FICO score, and then from there, we're determining products and programs that are available for. They get under contract. They seek a house, and they get under contract, and then we submit it to the lender. And the lender, when we send it to the lender, obviously it's going to the underwriter for that particular lender. And those underwriters do all sorts of, not only reviewing the information that we provide, but they also are looking at some of these data points that you're referring to, for any type of things that don't necessarily show up on an individual's credit report. So, can you talk about just what are things that, LexisNexis and other fraud guards, what are showing up? What are things that, would show up there and not necessarily on your credit report?
Yeah, I can certainly jump into that. So you're absolutely right, first of all, right? Even when I started my journey as a homeowner, you tend to put all your focus on sort of improving those credit scores because you think that's the single most important thing that is going to be considered when your application goes in. Little did I know, you first of all, I think one important distinction is between credit scores, right? Folks are trying to improve a credit score that might be visible on applications like Credit Karma, which often show you the Vantage 3.0 score, and they've been offering that score for the longest period of time. I think it's due for an update, and there are some tools that offer you monitoring for better scores, but most mortgage lenders are going to look at the traditional FICO 245. And if you're not monitoring your credit score, which is relevant to these lenders, then there might be some delta between what the score that you're monitoring and what lenders are going to take. Now, the issue here is the scores that you're going to be looking at are probably a little bit more forgiving compared to the traditional score models, which are which used to be stringent, right? And as a result, you might think that you have made it into a particular score band, only to realize that your mortgage broker or your mortgage lender pulls your FICO 2, 4, and 5, and your score is 30 or 40 points lower than what it should have. So that is one of the most important thing that I recommend to my friends and family, which is you need to track the right score that is relevant for your use case, which is getting a mortgage loan. You need to track the scores that your broker or your lender is going to be looking at. Uh, there are some
And Jay,
applications.
Jay, what is that? Is that FICO 5 or is it?
So it's FICO 2 for Experian,
Okay.
FICO 4 for TransUnion, and I believe FICO 5 for Equifax. These are
Because
the most commonly used FICO scores in the mortgage world, and most people don't track those.
no, they're relying on a Credit Karma.
Yeah, which is a Vantage 3.0. So you might be having a 680 uh, yeah, as a Vantage 3.0 score, but when your broker pulls your score, he's like, "Hey, yeah, you're just a 620."
Correct.
And like, "Hey, no, I just checked my score. It's a 680." But you are looking at different scores at that point.
Yeah. No, and I think it's so important because I get that all the time. I mean, as far as they're trying to be good students, right? They're trying to be good students and good, customers and knowing, hey, I know what my score is. Like I even had a lady last night say, I said, hey, your score is a 677, and she could swear up and down she's a 800. And she's like, can I see that credit report? Like she's dumbfounded. She couldn't believe that her score was lower than what she thought it was, as if I was lying. And so I was like, sure, I'll show you it, but this is what it is. I mean, so why? I mean, but it's proprietary. Is that the reason why people don't know how to track it, or where can they track the FICO 2, 4, and 5?
So there's a big story behind this. Um, and we can get into FICO versus Vantage whenever you think it's the right time. But on a high level, the the United States has been using FICO for almost 6 decades now,
Mm,
and it is a household score model. As a result of that, most financial institutions have traditionally been using FICO in their underwriting models. Now, these are very slowly moving institutions. They take a lot of time to change and disrupt. And as a result, you'll see that a lot of underwrite credit policies today are built around the FICO score, right? And Vantage is actually a score that was launched by the three big credit bureaus in a partnership much recently, I believe back in 1995, to compete with FICO.
wow.
The bureaus do have access to some really rich data. And if they are partnering up and coming up with a score model to compete with FICO, then there's certainly some weight to it. Now, when you're using any of these applications like Credit Karma or similar ones, it's generally hosted by one of the three credit bureaus. And as a result, they like to push their own score model into these credit monitoring tools rather than paying FICO, that's an external entity, for score tracking. Which is why you'll see that most credit monitoring tools will show you the Vantage score, which is not a bad, it's not a, I don't think one is better than the other. They're just slightly different score models, but that leads to discrepancy between the scores. And
Yeah.
yeah,
Well,
please.
well, they say Vanish score on just stats say 40% increase on eligibility for a customer, right? So a customer will have a higher probability, and that would make sense for all these customers that I bump into that are looking at Credit Karma, are looking at their Vantage score. They're seeing higher scores that are not indicative when obviously I pull it through a FICO. And so, there is a level of like, we're going to see a huge increase in more eligible buyers potentially if and when the lenders do decide to really open up the door. But now you're saying, and I might have missed it just spacing out, but you said FICO was created by the government?
No, my bad. FICO is a separate entity. So each
Okay,
of the three credit bureaus are also profit making organizations. They are
sure.
publicly listed companies. So is FICO. But
Okay, so
yeah,
then we have FICO here by itself as a company.
right.
They're the grandfathers of it all. They create the system, and then I mean, because I am curious. I've been doing this for so long, but even I don't know this. um how did they come up with a subsidiaries of Equifax, Experian, TransUnion? How did that all kind of derive,
So
if
they're not subsidiaries. Yeah, it's very interesting. And I'm glad I got to learn this from my company founders. But essentially, if you look back in the 1960s or even 50s, we never had the concept of a consolidated credit bureau,
Hmm,
which contained the database on the entire United States population. Technology was almost non-existent. The kind of technology we have today was non-existent back in the day. Until very recently, you used to get your credit reports through a fax machine, right? So
I
that's
remember.
how manual those processes were.
Yeah.
And back in the 1960s, I would say there was a time when you used to have smaller credit bureaus in each region of the US,
Hmm.
and they only used to operate and specialize in those small regions, and that's it. They had, their scope was limited to their location. They did not care about any individuals or consumers outside of their region. Now things started changing. Consolidation slowly started happening, and then there was a time when you had consolidation happen on the west, on the east coast, and in the midwest. So that consolidation eventually led to the creation of Equifax on the east coast, TransUnion for the midwest, and Experian for the west coast.
Hmm.
And these, once this consolidation happened, these are of course the private entities that turned into publicly listed organizations. And that's why you have each three of these bureaus very independent of each other, operating as credit bureaus. And there is some regulation and some anti competition regulation as well, which requires uh, to have a system which can have three bureaus so that there's no consolidation of power with any one of them. But they all pretty much operate as independent businesses today. And the same with FICO. So FICO
So,
does not own any database on the
hmm,
US population whatsoever. FICO is
right.
just algorithm. All they do is they have a recipe which is pretty similar to how Coke has their recipe for Coca-Cola, right? No one knows what's under the black box, and you can never exactly predict how the FICO score is going to behave, but that's their secret sauce. And they partner up with each one of these three bureaus to get the underlying data, which is the credit reports, to generate a score.
Correct. Got it. So the credit bureaus, TransUnion, Experian, and Equifax came together and formed Vantage Score.
That's right.
So why do you think they did that? You know, why create their own secret sauce? Why do you think they did that?
That's a great question because they own the data, and they were relying on this outside entity like FICO to get the scores, which they were fine with for the most period of time. But as you are seeing, even in recent times, uh, FICO is getting more and more expensive
Hmm.
for people to pull. They are really commanding an extremely high price to get their scores, and in a lot of people's eyes, FICO is the only option. So they're almost stuck, right? There's nothing else other than FICO, and you're almost going to have to pay the price that FICO is going to command from you. So they wanted to break this system, especially when they are in this advantageous position where you own the data. And the three bureaus that's hence came together, and they were quite confident that, hey, we have the team, we have the data, let's go ahead and build a score model that's a pretty good proxy to FICO.
Um, it's funny. In my head bounces around. But I was thinking of I'm in Chicagoland area, Chicago Bears, and for the long period of time, Chicago Bears have been playing at Soldier Field, and Soldier Field is actually owned by the Chicago Park District. And so, every year, every home game, you have, 67,000 people sold out going to these games because they love the beloved Chicago Bears. And finally, it dawned on them, why are we renting a field? Why don't we just own our own field? And so sometimes even the simplest ideas, the simple concepts of like, yeah, I should just own where I'm at. Maybe for whatever reason, convenience, what's the big ordeal, or maybe it's money now that it's been triggered, like, oh, why don't we just have our own score models? We don't need FICO's model. And
Right.
that's what it kind of looks like. So it's
Yeah.
interesting.
Very good analogy. Yes, that's exactly what they're doing, and they're doing pretty well. I think it's all about awareness. And when I speak with folks, I do see an awareness about scores these days, which is a good sign. You should know what different scores mean, and I think the acceptance for Vantage is increasing quite a bit. And personally, I at CRS, I have seen a very huge increase in clients that opt for the Vantage score versus the FICO score because, and I can share an article with you. We actually have written a piece on what what are the underlying differences between these two score models, and under the hood, 90% of the data points that FICO and Vantage are looking at are the same. There are some tiny differences by choice that make these two score models different. And, you know, it's, yeah, in commercial lending, consumer lending, in so many use cases, people have completely switched to FICO and they haven't looked back.
So I'm curious, whose hand do they have to shake? What party do they have to donate to really open up the door for Vantage to be, basically macro, to be where the lenders would accept a Vantage score credit? Because as of right now, I still have to pull a FICO score. I have to use that. I have to go off the middle score out of all three bureaus. But when is the day and time, and who do they have to make sure we can confirm this with so we can actually move forward with a Vantage score?
That's a great question. I think it's going to take some time, but it's happening slowly and steadily. The change needs to happen with the financial institutions that have written their very old credit policies around the FICO score. And I think the change is going to come from many directions. It starts with us, the people, right? I think the the consumers and mortgage brokers, an increasing awareness and preference for the Vantage score is eventually going to get communicated to these lenders. I would, in fact, encourage you, Dante, to always, whenever you're speaking with mortgage lenders, which I'm pretty sure you're speaking with hundreds of them, um, you should always bring the Vantage score up in your conversations, because it's the change needs to happen at the lender level. They need to understand that the Vantage score is actually a pretty good substitute. It's more cost effective. It's less predatory in terms of pricing compared to the FICO score, and pretty much does the job.
Yeah, no doubt. I mean, right now, and we spoke offline just about the concept. Like currently, a credit report for me costs $91. So for me to pull all three credit bureaus at the FICO level, it's $91, and so that's expensive. You're virtually saying $100. And that's just a single person. Now, if I got two people there, we're talking close to $200. And how much is a Vantage Score credit report? How much would it be currently?
A Vantage score credit report is going to cost you anywhere around $15
You
for
hear
all
it
the.
here, folks. $15. So just even from a business perspective, $15 to basically $100. I mean, it's just night and day, and virtually it's the same data, right? I mean, there's nothing they're getting more than what we're getting on a Vantage score.
No, the underlying report is the same report again, right? The score is just an add-on to a credit report.
Correct.
So I can have, you and I can have, if this is my credit report, I can calculate a FICO score on top of it, or I can calculate a Vantage score. The credit report remains the same.
Right.
So it's yeah, it's funny how there could be such a huge price difference, and that's the market that FICO has created for itself. I mean, I'll give it to those guys. They are certainly shrewd businessmen, and they have created a business where they are making a lot of money, which is also reflected if you look at the stock price of FICO. It's going through the roof uh,
Sure.
as a result, but we don't know how long that is going to last. There's Vantage, of course, but then there's this whole universe of fintech companies that are trying to create alternative score models to compete with FICO.
Sure. Yeah, it is difficult in nature because the credit data. I'm thinking of a client I actually was not able to help, but he was from Costa Rica, and then he moved into Florida. but we're right in that interim of less than 2 years, so there's not enough data available to determine what a score would be for him. You
That's
know what I,
right.
so with these fintech companies, if they're coming in, and I'm assuming if most of them may be from out of the states, that might be a say, hey, we got to be able to figure out where we can determine someone's score if I'm moving from Spain to United States, instantaneously. I mean, there's got to be a way we can track how they're handling payments and, whatever they're doing in their current country moving in. So it needs to be more global, is what I'm thinking, a global credit system, so we can have more fluidity with people moving abroad for maybe a cheaper life, or coming here for more opportunity.
Yeah, absolutely. I think you hit the nail on the head, right? I'm an immigrant myself. I moved to the United States back in 2017 from India, and despite of the and I used to work in Hong Kong for 3 years before that. In Hong Kong, surprisingly, it took me 3 months to start having a credit report. I was credit visible in Hong Kong quite soon. But when I came to the US, despite of the fact that I had really strong credit history and I've been good all my life,
Sure.
it did not translate to a good credit file coming here starting out. So it does take time. I think you certainly need patience. But I would encourage folks to go, do some research. There are always credit card companies and banks that will open an account with you, even as an international person,
Hmm.
without looking at the traditional credit scores.
Sure.
So you do want to open up that line as quickly as possible because all you need is one account for your credit report to get generated. And then now I think it's a great time because you have so many companies like uh, Self Financial and many others which focus on credit building.
Right.
So you
It's
can
it's
please.
just not a it's just not a packet. It's not, here, Jay, welcome to United States. Here's this packet of things that you're supposed to do. It's really word of mouth that is transitioning everyone here. I used to. Let me ask you: are you were you close to
No,
Punjabi?
I'm from Mumbai.
Okay, Mumbai. Okay, that's the capital, correct?
That's right.
Yeah.
Delhi is the capital. Mumbai is like the financial capital.
Well, yeah. Um, so I worked at a firm, and the majority of people that were there were from Punjabi. And so I really got a chance to integrate myself with the community. I went to a Sikh wedding, and so I it was, what an experience. I was like, whoa, what is this elephant doing here at 8 o'clock in the morning? So it threw me off a little bit. I was like, whoa. And they were telling me, Dante, this is nothing. If we were back in India, this would be going on for a whole week or so. Like, this is,
Yeah,
this is nothing. And I was like, man, it was amazing. It was amazing. But, so I have my experience with a lot of, the Indian population that were coming over. And we had we still do, Motorola was real big, early 2000s. So a lot of, they're transferring here, and it was almost like a little niche, because we were able to say, hey, these are all the things you need to do. The community really kind of helped that person as they moved over. But if you don't have that community, if you don't have that, there's not, it's not just, offered, it's not, given to you. You
yeah,
know what I mean? It's really, it's kind of sad to some degree, because you're really sink or swim. Either you're going to figure it out, or you're going to get beat up pretty good, until you're like, whoa, what can I do?
that's right. And it's changing, right? I think people are building fintech companies to address these issues. I'm happy to share a list of some of the companies that I think can help folks
Please.
early on. But I think that there's several fintech companies. Like there's a company called Empower Financing, which coming to the US, I did my MBA at Rutgers University, and I was not able to get a student loan because I do not have a co-signer in this
Mm,
country. So I had very few options where I eventually had to get a loan from a company in the UK at a very high rate because they were the only ones who would offer me a loan without uh, guarantee from a
wow.
co-signer. Uh, but today, I think there are many companies like Empower Financing that will give you a loan as an international student who obviously doesn't have any credit history
Sure.
by looking at other data points. There's credit, and I think you called it out earlier. Nova Credit is a credit union that is trying to blur the international boundaries to some extent. So things are happening, but I think progress is happening slowly and steadily. We are moving in the right direction, but it's going to take some time.
Yeah, definitely. Hey, I'm going to take a timeout real fast. I got to do some housekeeping notes here. So bear with me. This episode today is sponsored by Epic Mortgage. Whether you're buying, investing, or refinancing, call Epic today. That's 708-905-5300. That's 708-905-5300. It's your dreams, your goals. Let's plan together. Now, if you need a playbook, if you need a play-by-play, step-by-step way to help you build a level of wealth building opportunities in the real estate market, right behind me is my book. My book is out. It's called The Ultimate Mortgage Guide. It's available on Amazon. Make sure you check it out. It gives you a tutorial of just things you should know when you're entering the real estate market and the real estate industry. It's a great book, especially for around the holidays. So definitely check out The Ultimate Mortgage Guide, available on Amazon. Now, after this show is over, if you're on LinkedIn or if you're on Facebook, please go over to our YouTube channel, which is Epic Spotlight. If you're on Epic Spotlight now on YouTube, appreciate you. Just stay on there. Make sure you give this a like. Let us know that this is the type of information you like to hear and information that we're providing today. But right after the show, check out our most recent podcast with Timolin Bowens. Are you afraid of the IRS or worried about making tax mistakes? Discover the inside scoop from IRS enrolled agent and tax expert Timolin Bowens. In this exclusive interview, Timolin Bowens unveils the secrets to staying out of trouble with the IRS, maximizing your tax savings, and avoiding the most common costly mistakes, especially after COVID and the recent tax law changes. Learn how business owners and everyday people can protect themselves, file correctly, and stop fearing tax season. Obviously, we're going into the tax season, so make sure you check out the Timlin Bowen's most recent podcast. Now, we do have some preferred listings. These are listings that are available on the market right now. We're here to help you get pre-approved, and so you could buy your first home or an investment property. All these properties are available on my website at www.danteroyster.com. That's www.danteroyster.com. So you can go there to see all of them. I'll give you a couple right now. We have 16029 Circle Drive, Markham, Illinois. It's a single family, 3 bed, 1 bath, going for 105,000. Contact Keith Terry, 773-655-1360. We have 8442 East Kingston Avenue, Chicago, Illinois. It's a 4 bed, 2 bath home going for 280,000. Contact Evelyn Wood, 773-718-9742. We have 6832 South Bishop Street, Chicago, Illinois. It's a 2 unit building. It's got 6 beds, 3 baths total. It's going for 240,000. Contact L'Oreal Flowers, 312-774-4230. We have 14926 Kenton Avenue, Midlothian, and that's a 3 bed, 2 bath, going for 339,940. Contact Sebastian Kupiec, 773-430-8988. And finally, we have 2602 Hummingbird Lane in Humboldt, Texas. It's a 3 bed, 2 bath, going for 284,444. Contact CJ Jones, 281-356-0203. All those listings and more are available on DanteRoyster.com. So we do have a couple questions here, Jay. Let's answer some of these questions, and then we'll kind of come back and finish our conversation. Appreciate everyone listening today. Thanks for chiming in. So let's see. Incredible insights. How is credit scoring changing this fast? Well, I don't know if it is changing that fast, Jay. What do you think?
Yeah, I would say it's not changing that fast. it, it's a there's two parts to it. I think credit scores are changing at a pretty steady rate. I wouldn't call it slow. The acceptance of credit scores is what's not changing very fast, and that's a structural issue, right? Like FICO, for example, already has the FICO 10 and the FICO 10T scores that are
Mhm.
out. These score models are very modern, with they're very futuristic. They don't take into consideration one's health debts. They will, they are very forgiving for things that one should not be looking at during the underwriting process. But that's the same reason why many lenders that are extremely conservative and want to look at everything still want to pull the old scores, because they are scoring you against things that you shouldn't be looking at in today's time. For example, your medical debt. So
Right.
I think that there's way too many scores available today and way too many custom underwriting models as well, that a broker or a lender can leverage to make smarter, more accurate decisions, but they're just slow at implementing those new scores. And a lot of times, if I'm running a mortgage lending shop with 50 employees who are quite used to underwriting loan files using certain data points, it's very difficult at that level to instill change and, almost change your underwriting policies. There's often risks involved, so it's just not a simple score change. You need to back test those policies and make sure that those changes won't negatively impact the business, and, you know design your whole operation around it. So as a result, the slowest change, I would say, on the acceptance side of it, but that's going to change pretty quickly as well. I think there's some really good AI based tools that are being used in the market today that can help you test out different scenarios, different credit policies. And if you can test out a credit policy using AI, then with a very fair level of confidence, you can say that, hey, I think we are fine to move away from FICO 245 to a FICO 10, because actually it's going to help us work with more clients, accept more mortgage applications, and eventually lead to a net positive for both parties. So, yeah, I think we have enough scores. We just need to, lenders need to start accepting those new scores.
Well, they were talking about, I know they were trying to implement last year where we go to a two score model. Were you familiar with hearing about that?
Yeah, yeah. I think we have certain clients here at CRS that like to pull both the FICO and the Vantage, but I don't think that's sustainable in the long run, because you're essentially paying for the same thing twice.
Yeah. I mean, manipulation, market manipulation is always probably a fear on a higher level. And so, giving the ability for an independent mortgage broker like myself a choice to like pull both and choose which one's going to behoove me the better, I think long term they're going to have to figure out a better solution. But I mean, short term, we're going to take advantage. I mean, that's just the natural human way. But they're going to have to figure out a better way to, whether it's some type of median score out of the two, because I did have some notes here, and I did do some research. Let me see here. Like the Vantage score, has a 41% weight on payment history versus FICO 35, and credit utilization is 30% on FICO, but only 20% Vantage. Length of credit history is 20% Vantage, only 15% FICO, and then new credit is 10% on FICO, 11% on Vantage. So, I mean, to what you said, I mean, these are very similar, but the little tweaks depending on your story, right? And we talked about this. FICO to me is a snapshot, where Vantage score is more of the story. the story of your credit. So it seems to me, do they give us both options? Is that what they're looking for us to do? It'll be interesting to see how that plays out.
Yeah, you make some great points, and those numbers are on point, right? It's not skewed towards one direction. If you look under the hood, both of these score models have been customized for better acceptance. The overarching objective of these score models is to be very accepting and have maximum coverage, right? So I, you know, if the US has a population of 330 million people, of which today I believe 80% are credit visible, then you need a mechanism by which you can easily predict by looking at their credit data trade lines and behaviors as to uh, whether this person is creditworthy or not. And these minor tweaks by both of these score models are purely with the intention of in being very inclusive of you know maximum number of people. Like an immigrant who comes in is not going to have much credit history but might be very good with their credit payments.
Yeah.
So putting lesser weight to their history and more weight to their payments might be a more sensible scenario versus someone that is has been around for 30 years and they have an excellent length of history, but they've probably defaulted on a payment by error in the last 1 year, and that should not very negatively affect their credit score because there's enough weight that's also been given to their uh, long-standing credit history. So yeah, I think scores are going to evolve to be more inclusive so that even an immigrant that comes in will have a credit score and a scoring that makes sense for their situations. And I think the bureaus are doing a pretty good job with the Vantage score. If you look at on an average, the Vantage score has about 10 to 15% more acceptance with the US population, which means that there is a good chunk of the population that would not even get a FICO score back just
Wow.
because of the amount of information that is not sufficient on their credit file. In those situations, you'll see Vantage score still giving out a score with a very reasonable level of confidence. Now, for anyone who's new to the country or is young and just starting out, that could be a game changer.
Yeah, definitely. My conspiracy theorist hat, when I put that on, I wonder if if you look at the historic nature of just homeownership, right, over the years, 50, 60 years, I feel like we've always been in the 60% range, somewhere between 60 and 70%. And I wonder about the other 30% that have that opportunity. Are they, is it supposed to be like that? My conspiracy hat, is it, hey, we're going to keep these levels to a certain path, because if you're increasing, with the Vantage score, if Vantage score comes into play and it really opens up that opportunity, it's one of those situations where you definitely would start to wonder, like, I mean, we could actually be at 75, maybe even 80% of eligible constituents could actually be homeowners. Is that really good? That would maybe kill the rent market, that would kill the real estate investor. I just wonder if there is a cap, and it's always been there, and now these fintech companies and the immigrants are coming up with these ideas, and these are great ideas, but is that truly what the system wants? Just a
Yes,
thought.
no, you bring up a that's that's a great point of view. I think that what eventually is going to happen is you're also seeing a world where the weightage given to the credit report is decreasing because as an underwriter you're not just looking at the credit file anymore, so the dependency that one had on one's credit report a couple of years back, in fact, not even decades, was much higher compared to today, because now suddenly, as a loan underwriter or even as a broker, you have the option to look at so much more data. You can
Sure.
look at their home ownership history, you can look at their criminal history, you can look at their eviction history, you can check whether they have any liens, judgments, or past bankruptcies. You can even plug into their cash flow data, you can plug into their banking transactions and run some AI on top of it and predict with a very high level of confidence what their cash flows, what their monthly income, what their monthly spending looks like. So the the landscape is changing so fast that I believe that in the next 3 to 4 years, the you're only getting closer to the truth as a mortgage broker, as an underwriter. Before, you were just getting a very narrow view at one's credibility. Suddenly, you're going to have a very realistic and accurate picture, a 360-degree view of an individual. And as a result of that, I don't think that it's going to increase demand for real estate, but I think that there will also be a lot of bad players of that were getting access to these lines before, that will be flushed out of the system.
Oh, that's a great point. And because you got me thinking, if it's a sliding scale in that in that frame of reference, hey, I'm not just oh, I got a 700 score, don't I qualify? No, I'm looking at this. So the guidelines change. So
Yes.
yeah, more people, hey, my score is great. Well, so what? The average credit score, I think the average credit score is 727 on a FICO. And so now, let's say we use Vantage, it shoots up to 760, and we're like, well, okay, you're supposed to have a 760. We're looking at these other trends because these trends are telling us, the trend is your friend. The trend is telling us that this is too much for you right now, that you won't be able to handle it based on other factors that we've looked at. So, yeah, they're just going to move to get guidelines, and I think we'll forever just stay in this 60 to 70% range. Let's take another question here. Great episode. How do lenders stay ahead of compliance risks today?
That's a great question. So I think lenders are making very good use of data, and I can take one of our lenders who is in the personal loan space. It's a very plain vanilla uh, personal lending business. But in terms of compliance, there's access to some really great tools today that automate most of the KYC process for you. So they leverage tools like LexisNexis, Instant ID. You always want to make sure that the individual that you are lending money to is fully vetted. So they should a be the person that they say they are, and you should go out of your way even to ensure that you're lending to the right individual. And this applies more to the online lending space. But number two is using certain tools like instant ID is one product that we offer that is going to check this person's name against negative media search, global watch lists. There's a whole list of global watch lists which you need to run individuals against, and some people should could be involved in some sort of financial crimes or money laundering. There are AML lists. So there are products that are going to do a full rounded KYC around this individual, just to make sure that you are doing everything in your capacity to lend to the right person.
This, and this goes with a stat I have here. It says over 70% of lenders say their compliance workload has doubled since 2020. And so this has been a little bit of the burden this question actually presents some of the burden that's been on lenders, small boutique lenders, that margin is already small and it's getting smaller because of the costs. And so that's where we're seeing some of the consolidation, within our industry and within a lot of just the mortgage space and banking in general, because, as this compliance continues to grow and all this data has to, it's just more burden labor, from a labor perspective as well as necessary money perspective.
Yeah,
And, and so
absolutely.
that's a thing.
Absolutely. And, we often joke at CRS, we call our product compliance as a service, right? Because we have an expert team of folks that are living and breathing FCRA regulations. And our CEO, funnily, says a thing which is, why we move fast but also not break things. So we are extremely big on compliance, and we almost work with each one of our clients as consultants. We will sit down with them, look at their use case, and run it through our head of compliance and make sure that not just us, but us, our client, and even the borrower in some cases are all being compliant, so that our business model, our client's business model, is sustainable, and there's no hiccups further down the road. So my advice to anyone who's concerned about compliance would be two things, and both of them, not trying to sell CRS here in specific, but you should certainly work with an aggregator like CRS, so that you can get one, access to a good team that will be your guide, your consultant, to recommend you the right mix of products. And it it could be a very efficient flow, which brings me to point two, which is these flows don't have to be expensive. There are products available in the market today, uh, where if you're using a vendor that aggregates credit checks, compliance, ID verification, background checks all under one platform, you are eliminating a lot of your upfront fees, your monthly minimums, with one platform. And these, like our pricing model is a la carte. So you pay for reports as you pull them.
Got it.
Mm, then we are startup friendly. I mean, I would say most of our top clients today are startups, 3 or 4 years ago. So there are organizations like CRS available that will be your partners in making sure that you're being compliant and you're being efficient in your underwriting process, and you're getting access to that 360-degree view at the right price.
Awesome. Got a couple more questions here. Great questions. Thank you, audience. How fast is credit scoring technology evolving compared to last year?
That's a good question. So I would say, compared to last year, not so much. I think pretty much. I think we have the same score models that we saw last year. 10 and 10T were something that were launched last year. So we don't see too many new scores, but the reason for that is not that there's not better score models available, but there's no point to launch a new score model if the lenders are lagging behind in accepting these new score models. So, coming back to my previous point, I think it all comes down to acceptance. And once there's a broader acceptance around the market for some of these newer score models or even custom score models, there's a lot of companies today that will build you a custom score model for your particular use case, which looks at not just credit but all of these other data points. So I think it is evolving, but the evolution certainly is slower than expected. But I do expect the landscape to change quite aggressively within the next 3 to 4 years.
Awesome. We'll take maybe two more. Can smarter credit data actually help buyers get better terms? Uh,
Yes,
I'll- yeah,
absolutely.
absolutely. So that's an easy one. Let's see. Take on what's one fraud trend most brokers still ignore? I would say synthetic identity fraud. I really haven't bumped into, but I did read that stat that it is one of the fastest growing financial crimes. I mean, we see more of the individual, trying to be, as I say, trying to be cute with, documentation, which you really just can't do. It's just a waste of time because there's so many verification of deposits that we're verifying, verification of rents. It's just, we're taught, we got to steer clear of that stuff. But yeah, I would say ignore. I think we just don't see synthetic. We don't see a huge ring. Not yet. I mean, that's just not something we see on a regular basis. And then
Yeah,
let's
synthetic,
see.
I believe, is more prevalent when it's happening online. I think you are still in a much fortunate spot where there might be some face-to-face connection with your clients, but in the online lending space, synthetic fraud is going through the roof, and there's ways to eliminate that too. Now,
Yeah. And then we got two more, and then we'll get this wrapped up. How do unified data platforms reduce lender stress during pre-approval? It wouldn't be through pre-approval. It would actually be once contract has been executed and we get it to the underwriter. Lenders tend not to really necessarily work on it because of the cost. Really, the cost of compliance. They're going to wait until the file has already been in house, and now they're like, okay, are we really going to lend on this? Yes or no? So the pre-approval still is going to remain pretty much stressless. Now, to your point, Jay, I can, as an individual, purchase some of this, type of services and products, so I can have more of a view of everything that my underwriter will see, and that's something that wasn't there. Maybe at least I wasn't aware of 10 to 20 years ago. So that's something new.
yeah,
And then
absolutely. And sorry, please go ahead.
no, go ahead, go ahead.
Yeah, I feel like that also helps you build long-term credibility with lenders, because the files that go to them are just more vetted. There's lesser surprises down the road.
Yeah, no, and building relationships ultimately is what we are here to do. Whether I'm building relationships with a client or building relationship with a lender, it's still very important. So then there's that trust factor that they know I'm not doing anything wrong or anything that would hurt them in the long run. And here's the last question: what's the most surprising credit issue you see during underwriting? What is the most surprising credit issue you see during? Well, I mean, I wouldn't. I mean, just the LexisNexis. Going back to that, liens, tax liens, IRS liens that I wasn't, that doesn't show up necessarily on the credit report. Judgments, that don't necessarily show up on the credit report. Those are things that can always, like, oh man, you can't turn a blind eye to it, but we just don't see it on credit reports. So those are issues that I say during underwriting. Those are the surprises, stuff that currently right now majority of the underwriters are seeing because they're pulling fraud guard and LexisNexis type of things. We're not necessarily seeing that up front. So I think as a whole, the industry, we might have to consider products like CRS getting in front of these items up front before the underwriter sees them, so we don't have surprises.
Yep, agree.
So that is all, my man. I think we answered all the questions. It was hour went by pretty quickly. I can't thank you enough, Jay, for coming on and spending time with me and really explaining the credit stuff. And you took me some history, man. You explained FICO and where it all started. I appreciate that.
Same here. It was a pleasure being on your show, Dante. Thanks for inviting me, and I hope I could shed some light on how folks can manage their credit scores better, especially looking at the right scores that are going to move the needle for you.
Awesome. No, I appreciate that. And like I say, if you guys have any other questions, reach out to me or reach out to Jay. Jay, if you want to put your information in the chat just so they have your contact information. If you have any questions in particular, you can definitely reach out to Jay. And appreciate everyone. We'll be back tomorrow with Jess Ford. Have a little conversation about lending with Jess Ford tomorrow. So thanks, everybody, and see you guys tomorrow. Take care.
Thank you all.